When a geopolitical crisis breaks out somewhere in the world, financial markets react almost immediately. Investors begin to reassess risk, governments respond with new policies, and global supply chains can suddenly shift overnight. Within hours, stock markets that once looked stable can become volatile. But why does this happen? Why do political conflicts, wars, sanctions, and international tensions move the stock market so dramatically? To understand this, we first need to recognize that financial markets are not only driven by corporate earnings or economic growth. Markets are also driven by expectations. Investors constantly try to predict what the future will look like. When a geopolitical crisis appears, that future suddenly becomes much less predictable. And markets hate uncertainty. One of the most immediate reactions during geopolitical crises is increased volatility. When investors feel uncertain about the future, many reduce their exposure to risky assets. Stocks, especially growth stocks or companies tied to global trade, may experience sharp declines as investors move capital into safer assets. This behavior is known as a flight to safety. During times of global instability, investors often shift money into assets perceived as more stable. These can include government bonds, gold, certain commodities, and sometimes defensive stocks like utilities or consumer staples. But geopolitical crises do not affect every sector in the same way. In fact, some industries can benefit significantly from global instability. Energy is often the first sector to react. Many geopolitical conflicts occur in regions that are critical to global energy supply. When tensions rise in oil-producing areas, investors quickly anticipate potential disruptions in supply. Even the possibility of reduced oil production or blocked shipping routes can push oil prices higher. When oil prices rise, energy companies involved in production, refining, and transportation often see their stock prices increase. Defense companies are another sector that frequently benefits during geopolitical crises. When global tensions rise, governments often increase military spending. This leads to higher demand for defense equipment, advanced technology, and military systems. Companies involved in aerospace, weapon systems, and military infrastructure can experience strong stock performance when governments expand defense budgets. However, other industries may face significant challenges. Airlines, shipping companies, and tourism businesses can suffer during geopolitical crises because they depend heavily on international travel and stable trade routes. When conflicts disrupt transportation or increase fuel costs, these industries often experience declining profits. Technology companies can also be affected, especially those with global supply chains. Modern technology production often depends on components manufactured across multiple countries. Semiconductor chips, electronic parts, and hardware components may be produced in several regions before reaching the final consumer. If geopolitical tensions disrupt these supply chains, technology companies may experience production delays or rising costs. Another major way geopolitical crises influence markets is through commodities. Oil is perhaps the most obvious example. Because energy is essential to almost every industry, rising oil prices can increase transportation costs, manufacturing expenses, and overall inflation. When inflation rises, central banks may respond by raising interest rates. Higher interest rates can slow economic growth and place pressure on certain sectors of the stock market, particularly high-growth companies that depend on cheap borrowing. This chain reaction shows how a conflict in one region of the world can ultimately affect financial markets across the entire globe. Currency markets also respond quickly to geopolitical crises. Investors tend to move capital into currencies considered safe during uncertain times. Historically, the U.S. dollar has often strengthened during global crises because it is widely viewed as the world's primary reserve currency. A stronger dollar can have several effects. Emerging market currencies may weaken, global trade balances can shift, and multinational corporations may experience changes in revenue when converting foreign earnings back into dollars. But perhaps the most important factor during geopolitical crises is investor psychology. Markets do not move only because of economic data. They also move because of how investors feel about risk. When fear spreads through markets, investors sometimes make decisions based more on emotion than on fundamentals. Sudden sell-offs can occur not because companies have suddenly become unprofitable, but because investors want to reduce risk quickly. This is why markets often experience sharp declines immediately after major geopolitical events. However, history shows something interesting. In many cases, stock markets recover faster than expected after geopolitical shocks. Once investors gain clarity about the scale of the conflict and the potential economic consequences, markets often stabilize. Businesses adapt, supply chains adjust, and investors return their focus to long-term growth rather than short-term fear. For example, several major geopolitical crises over the past decades initially caused market declines. But many markets recovered within months once uncertainty began to fade. This pattern highlights an important lesson for investors. Short-term volatility during geopolitical crises does not always translate into long-term market damage. That does not mean investors should ignore geopolitical risk. On the contrary, these events highlight the importance of diversification. Investors who spread their portfolios across different sectors and asset classes are typically better protected against sudden geopolitical shocks. When one sector declines, another may benefit from the same event. For instance, energy stocks may rise while airline stocks fall. Defense companies may gain while tourism companies struggle. Commodities may rise while certain consumer industries slow down. Diversification allows investors to reduce the impact of these shifts. Another key strategy during uncertain times is maintaining a long-term perspective. Many investors make the mistake of reacting emotionally to headlines. Selling during periods of panic can lock in losses and prevent investors from benefiting when markets eventually recover. Experienced investors understand that geopolitical crises are part of market history. Wars, political conflicts, economic shocks, and international tensions have occurred repeatedly throughout modern financial history. Yet despite these disruptions, global markets have continued to grow over the long term. The reason is simple. Markets represent the productivity, innovation, and economic activity of millions of businesses around the world. While crises can disrupt markets temporarily, the long-term trajectory of economic growth has historically remained upward. This is why successful investors focus less on predicting every geopolitical event and more on building resilient investment strategies. A resilient portfolio is diversified, balanced across industries, and designed to withstand periods of uncertainty. Because geopolitical crises will always happen. Political tensions, economic rivalries, and global conflicts are part of the world we live in. Markets will react to them, sometimes dramatically. But understanding how geopolitical events influence financial markets allows investors to remain calm when volatility appears. Instead of reacting to fear, informed investors recognize patterns. They understand which sectors may benefit, which may face pressure, and how markets historically adapt over time. And in investing, staying rational during moments of global uncertainty can be one of the greatest advantages